Hi, in this video what we will see is the capital budgeting topic, which is probably the most relevant topic for a manager, which is useful to evaluate one project. Imagine you want to launch a startup. You define your product or your service, and then what you have to do is assess whether the project is viable or not. And to do this, we have to go through a capital budgeting exercise. We have to estimate all the cash flows in order to see whether the project is viable or not. So first thing, let's see how we estimate those cash flows. As we can see in financial accounting, we can separate cash flows into three types: the operational cash flows, the investment cash flows, and the financing cash flows. So we have these three types of cash flows. The last one, the financing cash flows, will not influence our project evaluation. So let's not consider this one in the capital budgeting exercise. When we want to see whether the project is viable or not, we don't care about how we finance the project, at least at this stage. We will look only at investment cash flows and operational cash flows. Let's take as an example a factory. Imagine you want to build a factory that produces glass bottles, okay? In order to have this factory, we need some investment. The major investment in most projects is the capital expenditure, usually referred as CapEx. It is how much you spend in fixed assets, in assets like the factory, the machines, tables, office furniture, and so on. Everything you spend on fixed assets will be the capital expenditure. Then you may also have the investment in net working capital. In most businesses, you need to have net working capital. For example, in this factory that produces glass bottles, you need the raw materials to produce the glass and then to produce the bottles. So you need net working capital, which include things like inventories and accounts receivables. Then, as a positive impact, you may have the salvage value. So when you use your assets after some years, you can sell them back to someone else in the market. And when you sell them, you will receive a certain salvage value. So you use a machine for 5 years. After 5 years, that machine still has some value. You can sell it on the market. And with this and other things, but these are the basic ones, you will get the investment cash flows, everything that is related with acquiring and selling assets, okay? Then we have the operational cash flows. And to build the operational cash flows, what we will do is using the income statement items. So we will build the operating cash flows in a similar way we would build an income statement, as you can see in financial accounting. And the first thing we have is revenues. So once you set up the business, once you build a factory, you start to operate, and hopefully you will get some revenues in a given year. So you start with revenues. To have those revenues, you need to subtract some costs, variable costs, fixed costs, the costs with employees, the cost with electricity. Every cost you may have in a company will be included here. Then you have the depreciation. So you buy one machine or one factory, and those assets will have depreciation over time, and in the income statement you will register that as a cost. Once we have this, we will get the earnings before interest and taxes, which is the operating income, okay? Then we need to subtract both interest and taxes. Let's forget about interest. Let's assume that this project is fully financed with equity, okay? Let's ignore the possibility of financing this project with debt. So there is no interest, so we are saying that this is equal to earnings before taxes. Once we have this, we are able to subtract taxes. You will have to pay corporate taxes if you have a positive profit. And once you have this, you get to the net income, the operational profit after taxes. Up to here, we have exactly what we would have in an income statement. But now we have to add back depreciation. Remember that we are not looking at the accounting net income. We are trying to find the operational cash flow. Depreciation is not a cash outflow. It's something that we need to record as a cost, but it's not something that we actually pay. It is simply an accounting procedure that we have to use in order to take into account the loss in value in one asset. So it is not a cash outflow. We should add it back. We just use it to calculate the value of taxes. Once you have this, you will get the operating cash flow. So now we have these two things, the investment cash flow and the operating cash flow. And for every single period, we can find these two things, investment cash flow and operating cash flow. Both things together will represent the free cash flow. So if we add investment cash flow and operating cash flow, we will have the free cash flow of the project. And with this, we know how much cash this project will generate this year, next year, in 2 years, and so on. So for each year or for each month, you can estimate the free cash flow that will be useful to you in order to assess the value and whether the project is viable or not.